All right, so I can see we've got a number of people have jumped on, which is fantastic, really exciting. So without further ado, we will start. Welcome everybody to joining our webinar, Getting Ready to Invest in 2024. This is something we do regularly throughout the year. We did a lot during COVID. Obviously, when people were in lockdown, we did a lot of webinars, and we wanted to get one in before the end of the year. We know it's an exciting time of year, so we will kick off now, and thank you for your time. Super quick, I'll introduce you to, our host, really. That's Lloyd Thomas. He's a founding director of DPN. Lloyd, how are you tonight?
Great, David. How are you, mate?
Really well, really well. It's great to have you with us. And we've put together a great session tonight. Lloyd, really interested to get your feedback on all things property tonight.
Sure. Looking forward to it.
Excellent. My name's David Bruce. I look after our customer experience team. I work very closely with Lloyd and have for a number of years. And as we said, we run a number of these webinars across the year. We love giving people information, insight, and inspiration about investing and building wealth through property. So welcome, everybody. And just in terms of some other housekeeping, there is an option there for you to pop some questions in the Q&A. We will look to get to those questions. We think we'll probably, our presentation tonight will go for probably about 30 minutes or so, and then make time to answer your questions. So please don't be shy to do that. Before I jump in and start asking Lloyd all the big questions, we always say we love a quote. This is one of our favorites. And look, the best time to plant a tree was 20 years ago. And when's the second best time? It's today. Yeah. I think we've all had that moment, haven't we, Lloyd?
Absolutely. Hindsight's a beautiful thing.
Yeah. The shoulda, coulda, woulda in property.
That's exactly it.
But yep, the second best time is absolutely today. So without any further ado, let's kick into one of the big questions, I guess, Lloyd. What's in store for property in 2024? And we've got a series of topics there, which I'll get you to walk through. The first one, let's get the elephant out of the room, interest rates.
Yeah, look, it's the question on everyone's lips at the moment, isn't it, David? It's where's interest rates going? What are they going to do? And look, it is a bit of an unknown for everyone. They can, there's sort of 50-50 bets every time the first Tuesday of every month comes up with the RBA sitting. And, even for next month, it depends on what they do. But one thing's for certain, they're not going to keep on going up forever. And there's always an opposite effect when interest rates go up, less people buy. And we'll go into that in a minute. But the thing with interest rates, it is a scary point for some people, especially with their owner occupied place. And, people are having to make some pretty hard decisions at the moment. But on the other side is where people are selling, you've got more people coming back into the market that need places to live. And we just don't have enough places to rent out at the moment. So
and look, the next point to that is absolutely right, is, looking and talking directly for people looking to invest or those that may have a portfolio. What does it actually mean in terms of interest rates?
Yeah, well, look, yes, interest rates will go up, but lending power can still be okay, because you look at the rents that we're seeing increase every day. I know, I had people when COVID hit sort of ringing up and saying, oh, what do I do? What do I do? And, sort of the sky's falling kind of principle of panic. And one thing I said, look, we've never gone through anything like this, a pandemic like this in my lifetime, that's for sure. But I know one thing for certain, that rents will always go up. When there's that type of undecision or unease in the marketplace, there really is they're emotional buyers. And so what happens is people stop buying and they stop having that thought of, I'll get another property or an investment property. And they really start to, that inertia hits them where they don't move ahead. They stop, they don't do anything. And so what we're doing is obviously, showing people that the facts are true, that interest may go up, but also you'll get rents going up as well. What we're hoping for is obviously the banks may look at lowering benchmark servicing rates for people in the future. That might make it easier for people to get into, the mortgages. That's
been predicted though, hasn't it, Lloyd? I mean, I think what we hear in the news is that into 2024, that there's a stabilisation. rates will come back. I mean, I know we hear from varied sources, but once those
Right.
rates do stabilize, it does give people a little bit more power in terms of access to lending and those pieces. It opens up for them, right?
Absolutely. And look, even some of the articles that have come out from some of the banks recently. I mean, there was one article a couple of months ago from one of the banks, and their head investment financial officer was talking about up to 7 rate drops next year. So look, I don't know whether it's going to hit that, but I'd say the second half of next year we may look at an interest rate drop, and if that starts to happen, you're going to see a flood of people come back into the market, and there's going to be another property boom. I really believe that, because there is such a pent-up demand of people wanting to buy property. I know personally, I've got clients waiting to be able to get into the market because they just don't service at the moment. If things change on the lending if things change on the lending side of things, with interest rates either going down or benchmarks for servicing going down, there'll be a flood of people coming back into the market.
Yeah, that's exactly right, Lloyd. It's the big topic. We wanted to start with the big news item, I guess, and really get that away, because there's lots to go through in terms of what the outlook looks like.
Yeah.
You talked about this just briefly before. Tell us about the lack of housing supply. People don't know that as well.
Look, we are so behind what we should, and I mean, we're experiencing. As some of the people online would know, we have our own rental management and look after well over 1,400 properties, and so we see some of those areas. We're down to around about, in some areas, 0.29%. So this is like, in other words, if you look on the market to try and rent anything out in that area there, you won't find anything. It's so scarce. The average for us at the moment is probably sitting around about the 0.8. So it's not even the 1% that is on average at the moment right through Australia. And even an article I read yesterday on immigration, we've got around about, just this year alone, there's going to be around about 600,000 new people come into Australia, and it's a lot of people to try and house. Here we have a crisis. It really is a crisis at the moment. Like, we've talked about, David, regarding getting people into rental properties. And we're bringing another 600,000 people to combat that as well, to try and fight for that same property. So as you've got there, locations, there's different locations that are obviously higher lower vacancy rates than others. But it gets down to that affordability as well. What can people afford? And, like I said before, where some people are going to have to sell their own family home, they're going to need somewhere to live. And so that'll go back and cause more demand in that rental market as well.
And, we can't build them fast enough either, as we know, Lloyd, which really lends into some of the other drivers we've seen through the period about the property market. Well, let's be clear about one thing. We always say there's not one property market, there's many property markets. Right. But we've seen the prices move, right through COVID, and they've really bounced back at the moment. Yeah,
they have. I mean, you just look at the Sydney property market, for instance, just in this year, with interest rates continuing to rise, the demands always became, stayed very strong through that whole process. But I think the other week it came out, it was like 7.8% growth over this year already. And that's pretty staggering when, some of the experts have come out and said, there's going to be a downfall and all this kind of thing. But it all gets back to that, law of economics, supply and demand. And there's a huge demand at the moment, not so much on the supply side. And so that's what we're seeing in those areas that we're putting our clients. I can't think of the last time we didn't have a tenant before the property was actually finished, waiting to go in the day they could. And so it's been a regular thing for us.
Absolutely. It's a very interesting time in our property economy, really, with all of these factors driving the outcomes. You touched on this before as well. It's super important, and again, really newsworthy. A lot of pressure on people finding rental accommodation, and that's not slowing either, Lloyd. As you said, not enough houses, massive immigration. People are looking to rent, so that rental market for investors, that's a real thing. And look, there's some advantages for investors in that.
Yeah, I mean, even the RBA put out an article last week saying that they don't see any ease for the rental side of things in the near future. And, what happens with rents. So, like I said before, you've got interest rates going up on one side. As soon as someone comes out of their lease, what's a landlord going to do? They're going to put up obviously the rent, because they need to cover their costs as well. And so you're going to see an increase in rental prices, and you're going to see a decrease in available properties for rent, because they're getting snapped up. I had a friend of mine in the local area here. They went to an open house the other day to rent a property. They had something like 34 or 35 groups through looking at that same property.
And that's reality. That's from taking from what you see on, Channel 9 and what you read in the paper into reality. There is that demand for it as well. I think the other side, if we put our investor lens on as well, is that, look, those rental yields, it does support that. It helps support if the interest rates are going up, that rental demand. And look, ultimately, as a landlord, you've got the choice of working with your tenants to get some really good tenants in there, look at longer term options as well. So it's not all doom and gloom in that regard.
Yeah, that's true. We're seeing people stay a lot longer in their properties once they're secure and and they're happy in that property. I was speaking to a client the other day, and he said he's had the same client with the property that we started him with 4 years ago. Same client, same tenant the whole time. And so we're seeing a lot more of that kind of thing.
So there's some really interesting statistics here when we start to talk about this chart, Lloyd.
Yeah, it's a little bit scary in some ways. You're looking at the amount of increase in rental prices over the last 12 months, and I know this is the average of what they've seen in Sydney, Perth, obviously Melbourne, and Brisbane, and you see them as the major players, but we've seen it up to 30 to 38% increases on some of the properties that we release, because just in 12 months the prices have gone up so much, and the average for those particular areas have grown, and as new properties come on that are built, there's a new threshold for people to, they've got to afford this to be able to live in that area. And so
and I think this chart doesn't tell the story of what we also see, like you said, about the other investment regions that we have put our clients into around the Hunter Valley, into the Shoalhaven, up into Brisbane and the Sunshine Coast. Similar numbers, right?
Maybe absolutely. Yeah, some of them are quite scary, and you see the increases. I've got a property. One of my clients has got a property up near the Sunshine Coast, and they were getting around about the 850. They paid 507,000 for it about 4 years ago. They were getting 850 a week rent. The new rental appraisals come out to $1,020 a week rent over that property now.
Yeah, that's a massive impact.
Oh, it's incredible in 12 months, and so there's some massive price increases coming because interest rates, again, it's offsetting that interest rate cost.
And in terms of the actual volume of rental stock, correlates, right? Again, numbers going in the other direction.
Exactly right, which is unfortunate, and that's why we need new new builds and properties on the market, because this just shows what's actually happening. There's 32% less properties available in Melbourne for rent than what there was 5 years ago, and so you look at that over there, you've got your top three all above 30% there, and it's pretty scary. It's something to really sit back and look at and think, okay, what needs to happen here? And the answer to that is there just needs to be a massive amount of properties built to be able to take up that volume of rental properties needed.
Yeah, that's absolutely right. And, we move on to the next piece here of some of the big numbers again. And, people listening to us tonight might be going, wow, there's big numbers, and they might have maybe some negative connotations to it. I guess what we're trying to paint a picture here is in terms of the market. Yeah, you've got a challenge with interest rates this year, and that's probably a long time coming, that interest rate after being at generational lows. But these are the real factors that are really driving our many property markets. And that number of 700,000 plus, I think these numbers just expand all the time. I mean, the number you said before was huge just this year alone.
Yeah, just this year. Yeah. It's good. It's grown like crazy.
But as you also touched on, Lloyd, we're not building enough property.
No, that's exactly right. We're not even treading water, David. We're going backwards at a scary rate. And that's why, I mean, this whole thing's about, okay, what's going to happen next year? Well, we know 100% that rents are going to go up, like I said, and I've said that several times already tonight. And the availability of rental properties is going to get less because there's so many more people in the market looking for them, and it's becoming harder and harder. And if we're only building, 160,000 homes a year, and remember, they're not all rental properties either. And so,
that's exactly right. Exactly right. And, what are the key takeaways here that we learn from this? That immigration is really going to fuel our economy.
Yep.
We know there's the demand for housing, as you said, but I think the upside to immigration is we know that level of migrants coming in, it's going to give us some great benefit to our economy and help to employment stability. So there's some real benefits to immigration. There's a reason why the government are doing it as well. And the drop is also, I think we have to reference that, they paused it during COVID as well. So there's a little bit of catch-up football happening at the moment, but it is going at a rapid rate that we're seeing.
Yeah.
So, I think that really covers a very broad outlook of where we see 2024 heading at the moment. And there's some really interesting points there for everyone to be aware of. I think the next focus and changing the pace a little bit now for us is to think about, well, as people who may have an investment property or considering to get into the market and thinking about what does next year look like for me and my family and building wealth, it really is a case for get ready now. Let's set yourself up for a really great year. And Lloyd, what are the key things that you could do today to set yourself up for next year?
Yeah, look, I think planning is a key. And one of the things that I ask people all the time is, do you have a strategy? And do you have a plan for the future? And you've got to look at the facts of, even when people retire these days, 82% of Australians will outlive their super. That means they retire and spend their retirement, basically spend their superannuation before they actually die. And so, as they go along, they've got to make some type of major financial change, either sell their family home, go, get a part-time job, or go back, re-enter the workforce. There's a whole bunch of things that they've got to do. But like we've got those points up there, establish your position, understand where you are now, and, determine your funding. And that just means understand, okay, I need funds, I need to borrow money. And so how do I get those? And getting a strategy, which is what we put together for our clients. Because if you have a strategic approach rather than just a transactional, I think that's the real key. Because most people, when they think, oh, I'll buy an investment property, they're just thinking about the transaction. What do I buy? What do I buy? And then they go to an open house or something like that. It's an old property. They haven't done much, very much research on anything on the area, except that they think it's going to be okay. And I call that the hope strategy. I hope it's going to rent out. I hope I make money from it. I hope I get a good tenant, and I hope that one day I can sell it for a profit. And there's no real strategy. It's really a hope thing. And so what I always suggest to people is, okay, understand you need a strategic approach to this. It's not just throw your hat in a ring and have a go.
Yeah, that's exactly right, Lloyd. And there's a bit more piece that we pulled together here, but you've touched on all of this. I think when we provide, people with a strategy, I think a lot of people say, well, what's a strategy to invest? What does that actually look like? Well, as you said, it's get your starting position, understand what those first steps are to get ready to be an investor or grow your portfolio. Lloyd, we've got a number of proven methodologies. You've been doing this for how many years now? 20 plus years?
Yeah, we've 25 plus years. Yeah, 26 years.
A really good formula. We've got an in-house research team, and we'll talk a little bit about some of the ways we help people invest shortly, and to talk about those methodologies. But the research is absolutely critical, and we're going to talk to you about some investment regions shortly as well. And as you quite rightly said, is set yourself up for that retirement you deserve, because people will outlive their super. One other interesting thing we always look at is it's not only outliving your super, it's a case of, look, how much is a pizza today? A pizza could be 25 to 30 bucks. That's a day. In 20 years, when people go to retire, that could be 55, 60 bucks as well. So it's factoring in the growth of that dreaded word inflation that's going to impact them as well, about how much money they need to have that future.
Yeah. And look, one of the things that we all understand, and a thing that I ask clients all the time is, do you spend more when you're on holidays, or do you spend more when you're working?
Yeah, absolutely.
And retirement's like a big holiday. Well, it's supposed to be. And if you plan for it and you're strategic about it, it can actually be a holiday. You can enjoy yourself. And there's a bunch of other statistics that people can look up themselves. But I read one years ago, and it was said the average person, or I think it was 19%, the average, it was like 80% of people will live off 19% of their previous income. And so that's a pretty heavy hit when you look at, okay, if they're on $100,000 a year, they've got to live off $19,000, in a year. And you sort of look at that and go, wow, there's some pretty crazy numbers there. And it's scary. And I think it really does cause people to say, okay, I need to plan for this thing. I need to plan for retirement. Even if you're in the mid-20s, 30s, this is the great thing you've got of value on your side there is time. You can actually do this quite easily.
Absolutely. So really now, again, we've talked about interest rates. We've talked about setting yourself up now for where you want to head next year in terms of growing your portfolio, getting that first investment property. Where do you start, Lloyd? How do you start thinking about what that finance and funding that investment? What does that look like?
Yeah, look, there's a whole heap of ways you can actually get started. Obviously, getting a strategy and that type of thing, which we'll talk about in detail a little bit more later. But really starting to set up a savings plan, starting to put some money aside and be diligent about that. And it's I have a lot of young couples come and see me about either buying their own home or buying their first investment property. And I just say, look, things are tough. You actually have to make sacrifices these days. There's got to be a diligence to actually saving. You've got to be regular at doing this, so you can either save, 10 to 20% deposit, plus obviously your costs. Use cash, obviously, if you've got cash available to you. And like it says there, if you've got equity in your family home, and there's obviously the availability of using that. And then using mum and dad's money and a family pledge or a guarantee loan. That's a real key thing for young people to get involved with property these days. A lot of people don't know how that works.
Yeah, that's a good segue to talk about that. You said this the other day, and it really is. It's the bank of mum and dad. A lot of parents have the equity locked up in their property, and it's an easier way to help younger generations get in. How does it actually work, Lloyd?
Well, the whole idea with a family pledge or using mum and dad's equity, if you've got a good income, and I've had this happen right across an array of different stories, from people earning a lot of money and getting back into the market after divorce or, broken down in marriages or whatever it might be. And they've used the parents' property as part of the security for an investment property that we've got them. And you're responsible for that whole loan. It's called a family pledge. And but what you're doing is you're accessing a parent's equity in their home as the deposit. All right. And so it becomes an easier way for people to get into the market rather than to sit there for years and try and save and put that money aside. So they can actually have a deposit. And so this is a lot quicker. And I always say to people, the quicker you can get into the property market, the better it is for you. And because you will make money if you buy in the right area. Obviously, there's some disclaimers around that. Just don't close your eyes and point a pin at something in Australia and go, right, I'll buy there. Have some calculated, sort of responses to where you should be buying. But you can actually use different ways and different methods on how to get that deposit as quick as possible.
Yeah, that's good. And a really good point around that, Lloyd. It's, this information is certainly not meant to be taken as advice in any way. This is really information about how we work with our clients to help them look to fund potential, investment purposes. And everyone's situation's different, and all funding criteria, terms and conditions apply to everybody, as we'd all be very well aware of. But if you're not, it's very clear that you do need to seek independent professional advice about making your financial decisions. And look, working with us, we can help put you in touch with those right people. I mean, having a great accountant is really important, and having a really good mortgage broker to help you understand everything around that's really important. All we really want to do today is just give people an idea of what that might look like and how you can get started. So that's great, Lloyd. Thank you for taking us through that. We'll move into the next section now. This is really exciting. I'm sure there'll be a lot of interest in this. The regions to put on your radar for next year, Lloyd. We've got it here to talk about. We'll dive straight in. We'll dive straight in because I'm conscious of time.
Yeah, that's fine. We'll go through this quickly.
Maitland. Make me want to have a glass of wine looking at this slide. So,
right, on holiday, David.
Yeah, exactly right.
Look, it's a great area up there. A very, very low vacancy rate in that particular area as well. Still affordable. You can still get something under $1 million up there, which is unheard of in the Sydney area. And that's something that's going to go up as well. Really good for rents, great population growth. There's a lot of money being thrown into the Hunter and that type of thing. You got, the area around Newcastle that's growing, and through that Hunter area, it really is a very, very strong growth area, and we've got a lot of clients that we've put in there that made a very, very good amount of money out of those properties, and they will continue because, like I said, there's a very low vacancy rate still, which means people, as soon as we put a property on the market up there, we're getting between 30 and 50 applicants, and it's consistent. It hasn't slowed down.
Yeah, that's right. And look, you can see here that the infrastructure being put into that environment through the health pieces there. We know a lot of the big firms have moved up there. Telstra moved their call centre up into that Newcastle region a few years back. So the jobs are there as well. It's not just a mining area. It's got the tourism as well. So, yeah, we really do have a lot of time for that Hunter and Maitland in particular as an area to keep an eye on. The next one, we'll move a little bit further north. We'll get closer to Brisbane. Logan. Lloyd,
really area. Sort of the southwest of Brisbane and that type of area. There's a lot of growth out there. Obviously, they've got the Olympics coming up in a few years' time. So there's a lot of money being thrown into that particular area. But this is one of the areas that we've seen huge growth in rental demand, and our vacancy rates in those areas are very, very low. Like, I think I saw one the other day. It was that was, like I was saying before, a 0.29% vacancy rate. And in a particular area, or in that Logan area, and so it's been a consistent one for us to have people get great returns on their investment out there. There's been a good amount of growth in capital growth as well, but the big thing is it's a sought after area for people to live, and it's changing that demographic. Where that style of Logan years ago sort of had a bit of a tarnish on it. That's all kind of gone now. There's brand new money that's coming into there, and people are seeking to find areas like that to live in. And Logan's been a real popular place for us.
It's so close to the CBD for employment, and it's close to the Gold Coast. And look, what we saw prior to COVID and then directly after COVID was the exodus to Southeast Queensland. That's unabated. What is it? The truck goes up, but they're all coming back empty. People are still moving to Southeast Queensland, and with the Olympics, it's just going to be a really popular place for investors over the next few years.
Yeah, people love it. It's a really, a place that genuine people really do like to live there.
Yeah, absolutely. We'll go west now, Lloyd.
Yep, Western Australia, and look, there's been a lot of growth over there. It's been very, very stagnant for many, many years. And in fact, it went back severely, and it's changing now. And there's one of the things that we do here at DPN, we don't just go on fads. We don't go to mining towns. We don't think, we'll go to that area because it's a mining town and it's got a mine there and there's thousands of people looking for rental properties. That's not what we do. We look for consistency. It can't be a one-horse town. The thing I'm seeing over in that western area in Perth, and there's a real consistency of growth. There's people that are moving there. One of the properties that I got for one of my clients today was in Perth, and he works on the railway line, which is on the north side there. It's all getting redone. They're extending that line up through that north area. And he's working on that line. And he said to me today, he said, "Oh, look, I want to buy there because I'll probably move back there. I'm there till Christmas, and then I'll probably come back and stay there permanently." And so people are really choosing to live over in the Perth. It's in that Perth area, in that Western Australia region. It's a really beautiful area, and there's some great spots there, both north and south of Perth.
Yeah, fantastic. And look, I think with that, they're just three of the key regions that we wanted to share tonight. As we said, we have an in-house research team. That's what makes
Correct.
us different, that we've got the access to the leading independent data. Everything is meticulously looked at. There's more than 8.5, nearly 9,000 suburbs in Australia. So
Yeah, that's right. Yep.
we're not
What
picking
a property
by
market.
chance. Yeah, we're not picking by chance. We're putting a lot of effort and independent fact into the areas that we look for our customers. So they're three that you should absolutely keep your eye on, and we'd love to talk to you more about the other areas that we think are of great value as well.
Correct.
So, Lloyd, getting into a little bit of a direct property talk now, maybe tell us a little bit about why we like properties that are like, dual incomes. Why do we like a multi-rental income? Why would that be of value to an investor?
I mean, the yield. The yield is fantastic, and they're rare. I find that people get a great return, not just in the weekly rents that they're getting, because you're getting two rents from the one property, whether it's what we call a dual income, which is you can't subdivide it. You can't subdivide it to one title property, or a duplex where you're getting two separate properties, but we build it under one umbrella. Then you can subdivide it once it's completed. But the thing that I find is getting those two rents. You never have an unhappy customer when they're getting two rents from the one property. The yields are fantastic, and as time goes on, we see that being stronger and stronger. I've got clients now that just even since COVID in 2021, that they bought properties in the 700 mark, and $700,000 to $800,000. And today, when they first started renting them out, they were getting $900 a week. They're getting $1,100 plus now a week for those same properties. And so they're, even with the interest rate rises that we've had, they're still severely positively geared. And
yeah,
so
that's great, Lloyd. There's a good winning strategy for that. And
yeah,
now we wanted just to take everybody here tonight and think about putting in a real investment lens on the next piece here about, let's talk about, what it could potentially look like for you. And here's a pretty big statement. It's, if you could make nearly $500,000 in 5 years, would that be of interest? And this is a really big piece that Lloyd and I have been working through the last couple of weeks about what this looked like. That's a big statement, and I really want to explain how this actually works, but we want to let that settle in for a minute to say, reality is, if you could make a significant return on an investment in that period of time, would that be of value to you? So without holding any further, I want Lloyd to take you through exactly what that actually looks like.
Yeah, it's $100,000 a year. I don't think anyone's going to sneeze at that.
No, you'd hope not.
No, exactly. I'll have it if you don't want it. So you're looking at, look, we've got an example here. This is a duplex, and they're like the perfect property if you can afford this kind of thing. And like we even talked about, just reflecting on what we said about the family pledge and how young people can get into it. I've had several people come in, couples, and they're saying, I want my kids to get into a property. They mightn't have had the money, the children, and they're not children, they're young adults, but their kids mightn't have had the money to actually buy this on their own. So mum and dad go in with them and they buy a duplex, and they might do half each. But there's what we call manufactured growth. All right. So you might purchase the property for 1.3, as we've got here as an example. Completion value is going to be worth between 1.5 and 1.6. So they're going to be worth $750,000 to $800,000 each side once they're completed. You put $1,000 in. If you're using equity out of your own home, you'd use that equity or family pledge for the rest of it. And then you can literally have 100% borrowings against that property with the strategy that we can put together with you if you have that equity or family pledge process. And as you can see, we've only used the capital growth rate here of 4.75%. And, like I was talking about before, where people are, in year 2020 and 2021, and even, it's even more severe in the years before that with what it's worth now. I've had clients like in that 700,000 to 800,000, those properties are worth between 1.3 and 1.5 now. And so they've had massive growth over a short period of time. Now, we've had abnormal growth within that COVID time. But in normal situations, we're still seeing that consistency by buying a duplex because you're getting that manufactured growth. And that's quite a sensible way of getting a property that's going to make you earn about $500,000 over the next 5 years. And like we've put down there, we're only using 4.75% as a capital growth rate there. So it is actually quite conservative.
Yeah, that's right, Lloyd. And we know that we're the property, and again, many markets and different capital growth rates in different areas, but using a very conservative average of 4.75 per annum does throw back, a really good number. And I think there's two pieces there. I'll ask you a question, but I think there's one other really important point here. Any investment, there are going to be some holding costs that sit within that as well.
Right.
I mean, obviously you have loan repayments you've got to have and things like that. But I think what we're trying to demonstrate here is that you're getting a really, really strong rental yield to support that investment, and the return over that 5 years is really significant anyway. What I wanted to ask, or maybe if you could help explain just a bit further, that piece around, putting a purchase price down for 1.3 and then getting a realized value of 1.5. Could you just explain for everybody exactly how that works?
Yeah, so and just to clarify, that 4.75% is an amount that we use as a capital growth rate. It's not the capital growth that we're looking for. We're looking obviously for greater areas than that, but that's our base. And we're very conservative the way we put our assumptions together. 4.75% just means that over 15 years, that's what we call a property cycle, where a property will double in price. So don't sort of think that that's what we're aiming at. That's what we're using as our benchmark, as just examples here. Now, to buy a duplex, you might pay $1.3 million for it, but you're buying two properties. And because you're buying one block of land, you're utilizing everything you can about that block of land, and you become like a little developer in some ways, and this example is not just a hypothetical. This is on an area down south that we've got just past Wollongong and Berry, and there's fantastic growth going on down there for the next I really believe in the next 5 years, it'll be one of those areas that people go, oh, I wish I'd bought down there. In this particular area, there's one of my mates who's actually a developer down there. He's got a spot that Coles are going to buy in there. There's Homeworld getting established down there. There's Harris Farm. There's a whole bunch of retail precincts. This is a brand new suburb that's really getting built in that particular area, and it's going to grow. That's why I'm saying that that's probably a really conservative amount, and especially even when we're dealing with today's numbers, not even completion time, because we know it's going to be greater once this property is completed, and we're seeing that all the time. And rents, again, what we're saying there, that rental of $12.40 a week, that's got a vacancy rate in that particular area of 0.89%, so it's still way less than 1%. If we had that on the market today, we'd have them rented out in less than probably half an hour, both sides.
Yeah, really popular, really popular. And I think it's really important for people to understand, again, that point is that you've got the opportunity with that duplex that when you subdivide, that you get, you can get those two independent valuations, and that brings that equity up. And that's where you get that instant, what we call manufactured equity. You're starting, you're not starting from scratch, you're actually starting ahead of the curve. And that's what gives you that really good investment strategy. So,
yeah, and you can keep one, sell one, you can sell them both, whatever you want to do, but it gives you a choice. That's the greatest thing with this.
Absolutely, absolutely. Look, I'm really conscious of time. We are getting close to the end, and I want to make sure if people had some questions, they might want to jump on and ask. But I think, Lloyd, the next piece around this is obviously, the reason we're hosting this webinar is we want to help people. So, how do people start, Lloyd? What would you recommend they do if they want to start thinking and talking to us about this kind of opportunity?
Either send an email to hello@dpn.com.au, as it says there on the screen, or the 1300 number, and we'll book a time with you. One of the team will actually ask you a bunch of questions to do what we call a fact find, and then they can put you in touch with one of our team to do an appointment. Someone like myself, they can sit down and go through stuff over the phone and sort of put a strategy together, but also then once you're qualified for, we sit down to a qualifying period, and we actually look at it and go, right, okay, let's put a full strategy together, and we send that out to you and go through it with you in detail.
And is there any cost to that, Lloyd?
It's actually free, and we've still kept it as a free service, because when people see the plan and the strategy we put together, it's quite compelling. People love. Basically, it doesn't cost them to do anything with us, because the way we actually go through and make our income, I'm a licensed real estate agent and a licensed finance broker, so we get paid from another party, either the person that's selling the land or the banks that we're doing the finance through.
Yeah, absolutely. And that's really important to know. And I think that's the way we work with our customers, about being transparent and giving them confidence around that. And obviously working with us, there's no obligation as well. We literally have helped thousands of people, become property investors, get portfolios. Many, a large bulk of the people that work with us, they're referring their friends, their family, and they're looking at those repeat purchases and building out portfolios. So that's how we work. I think probably before we jump into closing out, I just wanted to see if we did have any questions jump on. I can see we've got a number of participants that have stayed the journey with us, and I appreciate it's a school night as well. So thank you. I wonder if anyone had any questions, they can pop it into the Q&A, and we'll give you a minute around to do that. Hopefully it's given you a really good flavour to talk about where are we today, what does 2024 look like. I know we probably started with a few scary topics of interest rates and housing shortages and rental pressures, and they're all real. I mean, you don't need to get on a webinar to talk to us about those. You can just turn on the radio on the way to work and you hear those as well. But what we wanted to do tonight, Lloyd and I were really passionate, was about, well, what does that mean for investors? What does it mean for people that are thinking about, how do I build wealth through property next year? How do I get started? So we've got one question here. Great. So we've got a question. Is any areas south of Perth that you'd recommend for an investment property?
Look, there is, and what we do, we when we do a strategy for people, we actually look at their affordability, and so there's some really good little spots down there, and you've even got down to Busselton and Dunsborough and all that type of thing. But there's some other really strong areas in between Perth and that type of area. But what we do is say, right, okay, part of our strategy and our point of contact is going, okay, your affordability is this. Let's work out the best area for you. And we show you why that is a particular part of the strategy. It really does give people the understanding of, okay, that area is a great area because I can afford that. If you can afford a duplex, we put you into a duplex. But then otherwise what we do is find a dual key or a suitable property for your affordability. So there is some areas down south of that.
So we've got a couple of other quick questions here, Lloyd. Talk about someone who's already got some residential investments. They're saying, should I look to move into commercial properties? That's a whole nother investment strategy. And look, we don't do commercial property investment per se. I think there's a different return metric that sits around that.
There is. Look, I find when things get tough, interest rates go up, businesses become a little bit tighter. Probably the last place I would want to be is in commercial property, because if businesses go broke and they're your tenant, you've actually lost your rent and your income from there. The other thing is too, you've just got to look at the return that you're getting on commercial property at the moment, and it's definitely every year becoming less and less. And prices are still going up, so you're still making good capital growth, but the yields that a lot of people were getting years ago on commercial property is just not there anymore. And to give you an example, I rang up about a property just recently, a commercial property in local area, just purely for interest sake. It was $780,000, and the agent said you'll get between $590 and $610 to $620 a week rent.
Well, there you
go. I've got property, that high sevens, and one of my clients actually purchased one today. And it was 787, I think it was, from memory. We'll get them probably $860 to $940 a week rent.
Okay, so a different parameter, isn't it, Lloyd?
Massive difference. And also interest rates are cheaper on residential property as well. And everyone, even in a crisis, people need somewhere to live.
Yeah, really good point. There's a really good question here that I'm dying for you to answer, because I know you're passionate about this. What are our thoughts on rent vesting?
Look, I think it's a great option for young people, or people getting back into the market. I think it's a great option, and I've got so many cases where I can show that it's outperformed your personal purchase, and I've seen this over time and time again, where people have gone and bought something, and especially, and I'm not picking on young couples, I'm using them as an example, because they do want to get into the property market, but some of them don't know how to, and they might run out and buy a property, which I just had a client several years ago. They went and bought a $720,000. They paid for it. Earlier this year, I did a valuation for them, because they came back to me and said, look, we want to invest now. And so we did a valuation on that property. They paid $720 for it in 2021, and it came back at $700,000 now. So it was a unit, an apartment, and so it lost $20,000 in value. But at the same time, one of their friends actually bought a duplex off me. They paid $727,000 exactly at the same time. That property is worth $1.35 million now. So $1.3.5 million. So $675,000 each. So big difference result. And it's positively geared. They're getting $1,100 a week rent.
And when you're investing, you can choose to live where you want to live, where you work, where your family is. You may not be able to, a lot of people have grown up in, some great suburbs, and mum and dad might be around the corner, but you can't afford to buy there. So, or you might want to live by the beach and have that lifestyle, but you can still build a portfolio. So we're big believers in rent vesting, and
gives you choice.
Anyone about that. We've got one last question, Lloyd, here.
Yep.
A little bit more of a technical one. Purchasing through a company name, what would you see as the initial pros and cons with that?
Look, I think that's a real question rather than to answer that over, the Zoom meeting that we're having now. It's probably an individual question to go through with their accountant and understand that. The biggest trap, a lot of people think by setting up a company and buying a property, it's a great way of protecting you. And look, it can have some advantages. But you've got to look at the income that's running through that. And so there's a whole bunch of other stuff. As an accountant, they can help you understand the best process for you on that. And we can work together with their accountant to make them get the best outcome that they want.
Yeah, great. Thanks, Lloyd, for that. So, look, on that note, again, I will just remind everybody, as we said tonight, certainly not financial advice. This is information. Right. This is to help give you some insight and some inspiration, and to start a dialogue and to get people thinking about what might be a great way to build wealth through property, and to introduce, Lloyd, his experience and how we work with customers, and just share a bit of our knowledge on how we're working day to day in property investment, because we're really passionate about it. And you'll see on the last slide there, simple website, easiest one in the world, dpn.com.au. Please visit it, have a look. Plenty of information, plenty of research, plenty of tips and information in there about investing and building wealth through property. And really, I'll probably close with this, Lloyd. Why do we do what we do? We want people to do what, Lloyd?
Live the life they want, David. That's it.
100%.
And I love doing it. I love doing what I do. And I do it with a passion because, I want people to succeed. I want people to win.
That's exactly right. So, look, Lloyd, thanks so much for your time. I've taken you right around the property globe today with all the pieces we've talked about, but I think it's been a great session. So thank you very much for your time.
No worries, mate. It's been a pleasure. And thanks, David, for joining us as well.
No worries. All right. Well, we'll sign off there, and thank everyone for your time tonight. You've got the contact details. I'll just say them quickly again. hello@dpn.com.au. Drop us an email, set a time, and we look forward to talking to you. And thanks again for your time.
Have a good evening.